Pick n Pay has sunk further into the red. The supermarket group has rung up an interim loss after tax of 827 million rand. That's from a loss of 571 million rand previously. This reflects the trading losses in Pick n Pay and higher borrowing costs. It comes as the group implements its turnaround strategy. A statement from the company says that it anticipated a challenging first half, but it did make progress in a number of key strategic areas. And so Pick n Pay says it expects its full year 2025 results to show a meaningful improvement on those of the 2024 financial year. In the meantime, Pick n Pay subsidiary Boxer has announced the long-awaited details of its listing plans. The group will list all of its issued ordinary shares on the JSE's main board, and there will be a secondary listing on the A2X. Boxer says it will also offer for subscription newly issued shares to selected prospective investors. The listing is on track for later this year. Pick n Pay previously announced its intention to raise between 6 and 8 billion through the offer, and now expects the base size of the offer to be towards the upper end of the guidance provided. Boxer is South Africa's fastest growing grocery chain with industry-leading market share of the discount grocery segment. Balwin's first half profit has more than halved. That's as the residential property developer felt the pinch of a subdued market due to high interest rates, and as a result the company has decided to not declare a dividend. But a recovery could be on the cards. Balwin says that the recent 25 basis point cut in the prime interest rate is a positive step. Delta Property Fund has sold 5 properties. This is part of the group's strategy to optimize its portfolio. The firm says the assets are not strategic and were disposed of via auction. Collectively, the sales amounted to 63.6 million rand. These funds will be used to reduce debt. The disposals will also cut vacancy levels by 2% and minimize annual operating costs, which will enhance the company's return on investment. Gold Fields has completed the acquisition of Cisco Mining. That's after all conditions to the transaction were fulfilled. The deal enables Gold Fields to consolidate 100% ownership of the Windfall project. The firm paid 24.6 billion rand net of cash received as settlement for the transaction. The payment was made using cash on hand, undrawn debt and liquidity facilities. Gold Fields says it remains in a solid financial position, and this should improve further with strong cash flow growth expected for the balance of the year and into 2025 as production volumes increase at several of its operations. PPC has forecast an earnings jump. The cement maker expects headline earnings per share to be as much as 18% higher and earnings per share to rise by at least 11%. The improvement is largely due to lower administration and operating costs in South Africa and Botswana. This partially offset a weaker performance in Zimbabwe. PPC will release its financial results on November the 18th. In international news, Boeing just launched a stock offering that could raise up to $19 billion as the plane maker looks to strengthen its finances, squeezed by a month-long worker strike and a year-long safety crisis. Here's more detail in this package report.
Boeing launched a major stock offering on Monday, which could raise up to $19 billion. The playmaker wants to strengthen finances squeezed by a month-long worker strike and a year-long safety crisis. The US giant is offering 90 million shares of common stock and $5 billion in depository shares. The move should boost Boeing's battered finances. It's been hit hard since roughly 33,000 workers walked off their jobs in September. That stopped production of models including its cash cow 737 MAX aircraft. The firm was already in trouble after a regulator capped production of its MAX jets following a January mid-air panel blowout. The combination of production and labour problems has caused Boeing to burn cash the last 3 quarters. Last week, the company reported a $6 billion third quarter loss and said it would burn cash next year. Striking workers also rejected an improved contract on the same day. A capital raise is for Boeing to preserve its investment-grade credit rating. Ratings agencies have warned a prolonged strike may lead to a downgrade in Boeing's credit rating, which could push up the cost of capital. The strike is also costing the company more than $1 billion per month. That's according to one estimate released before Boeing announced it would cut 10% of its workforce. Earlier this month, Boeing entered into a $10 billion credit agreement with banks. It also announced plans to raise up to $25 billion through stock and debt offerings.
And oil prices tumbled after Israel's retaliatory strike on Iran over the weekend bypassed Tehran's oil and nuclear facilities and did not disrupt energy supplies, easing geopolitical tensions in the Middle East. Here's more in this report.
Oil prices tumbled on Monday. Markets were relieved after Israel's retaliatory strike on Iran over the weekend left oil production facilities unscathed. Traders also noted Tehran's relatively muted response to the attacks, which raised hopes that further escalation could be avoided. Brent and US West Texas Intermediate crude futures hit their lowest levels since October 1st at the open. The benchmarks had gained around the same amount last week in volatile trade. Markets had priced in uncertainty around the extent of Israel's response to the Iranian missile attack on October 1st and the US election next month. Scores of Israeli jets completed 3 waves of strikes before dawn on Saturday. They hit missile factories and other sites near Tehran and in western Iran. But they bypassed Tehran's oil and nuclear facilities and didn't disrupt energy supplies. That led some analysts to hope the move provided a de-escalatory pathway, though they will watch closely to see if Iran counterattacks in the coming weeks. Citibank lowered its Brent price target for the next 3 months to $70 a barrel from $74. It said it factored in a lower risk premium in the near term.